Let's go across and touch base on the fundamental side of the market. A view coming in from Pramod Gubbi, who's BP Institutional Equities at Ambit Capital. Pramod, good to have you on the show. How are you looking at the market now, talking 6,600 and beyond, ahead of elections as we really count down to the event mid-May?
Yeah, fundamentally speaking, I guess you would get a bit too uncomfortable with the speed of this rally, particularly if you look beyond the index into the constituents of the index. Some of the cyclical names, some of the industrial names as large as an L&T or an ICICI Bank have rallied a bit too sharply. But having said that, if you're sitting back and taking a 2-3 year view with a positive view of the elections, then I guess it's just the beginning of this rally. So for those who are willing to take those longer-term horizon bets, we would still recommend buying into this rally, particularly in the quality cyclical space.
Interesting. So by the quality cyclical space, are you sticking to capital goods and the large ones at that, or are you also going on to the metals pack, because there has been a dichotomy in the performance between these two cyclical baskets?
We will stick to domestic cyclicals, given metals also depend on international cues as well. We're not too particular about the outlook in China in terms of demand to drive these commodities up. What is good from the metals pack and the commodity outlook, if it's softer globally, is positive from the current account perspective for the economy in general. And that's going to work through interest rates and hence create a more positive environment for domestic cyclicals. So we would stick to domestic cyclicals, and within that, like I said, capital goods and industrials, starting with L&T, would form the core of our quality cyclicals portfolio.
Given that banks have not really been an active leader in this market up move, of course, the last few percentage points have come in from the banking space. What do you make of the potential upside for private banks as well as PSU banks, which are ranked underperformers for a while now?
I think the banking space, like the rest of the market, has seen that polarization to some extent. At the one extreme, you have the really high-quality banks like the HDFC Bank, Kotak Mahindra banks of the world, trading still at significantly premium multiples, closer to 2.5-3 times price to book. The other extreme, you have the public sector banks, which are perhaps at best at book value, but a large part of them at 0.5, 0.6 times price to book. So it's a difficult call. In our view, the sweet spot is somewhere in between, the likes of an ICICI and Axis, which clearly don't have the same problems that you would face with a public sector bank in terms of management and ownership and compulsion to lend to certain sectors, but at the same time offer reasonable valuations at 1.3, 1.4 times price to book. So that would be a sweet spot, ICICI and Axis. Public sector banks were a bit too wary, given capital requirements are going to be quite onerous. It's not clear how the government will go about recapitalizing some of these balance sheets. It also depends on what valuations the recapitalizations happen, and that will have implications for dilutions for a minority shareholder. If we do see those recapitalizations happening at higher levels of valuation, which would call for a sharp rally in public sector banks in the next 3 to 6 months, then it's perhaps a good bet. But given uncertainty around that, given the government's own ability to recapitalize it on its own accord, we would stay away from public sector banks for now.
You've been vocal and vociferous recommenders of IT, large cap IT stocks. I remember your calls on TCS, HCL Tech, etc. Suddenly that space has taken a backseat and people are favoring cyclicals, as you said. What happens to IT? Because there is a large portion of the market which is heavily invested in the IT space. What do? Switch or stay invested?
I think the sector as a whole, you perhaps cut down on your overweight positions, bring it close to neutral. I won't even mind going a bit underweight if you're looking for pockets to take profits and raise funds to invest in cyclicals. But within the sector, there's still a couple of good names to stay invested in. We'd still bet on TCS and HCL Tech, which have consistently demonstrated their ability to grow as well as improve margins while staying underweight on Infosys and Wipro. But you do have to take a call on IT. It's done well. It's made money for you. So it's about time you take profits and look to deploy it elsewhere.
Right, but within the IT pack, Infosys, given the growth warning, slipped quite a bit. Was that being seen as an opportunity to buy the stock?
Not yet. I think we've been quite negative on Infosys for the best part of 4 years now. We got it a bit wrong over the last 12 months since the arrival of Mr. Murthy, which did create some sort of optimism from the market standpoint in terms of his ability to turn it around. Whilst we don't doubt his capabilities, the problems with Infosys we think are far deep-rooted. Even exacerbated given the departures of some senior management team members over the last year or so. We don't think that these departures will go unnoticed. It will have some sort of disruption on the business, which we've already seen in the first quarter with the profit warning coming through. Since then, there's been another departure. So whilst we don't rule out this ability of Mr. Murthy to turn this around, we don't think it's a short-term possibility. In the short term, we're likely to see more disruptions. So we'd stay away from Infosys even at these levels. We'll perhaps stay happy with the TCS and HCL Tech.
A quick perspective on what he's making of the oil and gas sector. And Pramod, just to take that point forward where, Neeraj highlighted the kind of attention the space is getting off late. First, drilling it down to specific names. Do you think it's a good time to buy Reliance ahead of the impending price hike?
We wouldn't buy Reliance for this price hike. As you know, the E&P business for Reliance is not that significant from the overall scheme of things. At best, depending on what estimates you believe in, it's somewhere between 30 and 50 rupees per share in terms of value. For a stock of 900 rupees, it's not that material. There are other factors, bigger factors, which would be driving the investment case for Reliance, most of which, in our view, remain negative. So to that extent, we would still remain underweight on Reliance.
What about the space at large, though? People talking about the rupee strength and the benefits that come to the oil marketing companies in particular, or the under ownership in the other oil and gas giants. Do you touch anything at all?
Yes, I mean, the oil and gas space is something that we've been positive generally across the oil marketing companies and also the government-owned E&P companies like ONGC and Oil India. Within these, our topics have been ONGC and BPCL. The reason being, I think pretty much everybody has been surprised by the sustenance of the diesel price hikes that the government has undertaken, even this close to the election, which is pretty much unprecedented. It gives some confidence that the government is serious in terms of reducing the under-recoveries for these companies, which are clearly positive. On top of that, if you're seeing rupee appreciation and some softness in crude price, this adds to the bullish case for both OMCs and ONGC. The only risk is we need to closely watch the developments in Ukraine, which can pose a geopolitical risk to crude prices if crude prices start climbing from here. A lot of the catch-up in terms of fuel subsidy reduction could get undone. Outside of that, if we look at the government change and the new potential philosophy of the new government towards fuel subsidies, that augurs well as well. We could likely be looking at full diesel price deregulation 12 to 18 months out, which is again a structural positive for these companies. It's very difficult to estimate the direction of the rupee just yet, given so many moving factors with the Fed tapering still on the cards and also the global outlook on commodities. So we would not factor in a substantial rupee appreciation for the bull case on OMCs. At this stage, focused on subsidy reduction, that itself is a positive, and we will stay buyers in ONGC and BPCL.
And ONGC, I don't know if people are factoring in a higher than a 5-6 rupee dividend that could come out today, because it's certainly on fire in the session. Just one word really, we just did a story. I mean, everybody knows about the asset sale in JPA to happen today. We just did a story about one of the asset sales going through for 1,200 crore rupees. And, JPA or maybe a handful of other infrastructure firms have done this bit, selling off assets to deleverage the balance sheet. How do you read the moves? And do any of these enthuse you, either JP Associates or any other infrastructure company?
It's still early days, I would say, to chase any deleveraging stories. It is positive, no doubt, absolutely, no taking away from that. But we think it's just in the first phase of that happening. The first phase would be to sell off assets and reduce debt. The second phase would really come in, I would think, about 6 months into the rally when the QIP market opens up and these balance sheets get further shored up through equity issuances. Again, just like for some of the PSU banks, it all depends about valuations. Do you issue this equity? Is this dilutive to minority shareholders or otherwise? So we'd have to wait. We won't rush into buying some of the broken balance sheets yet. We'll closely watch the deleveraging initiatives that they are undertaking, and so far it seems positive. But at this stage, there are a number of other better balance sheets, better managed balance sheets out there to buy in the cyclical space.
Fair enough. Then before we let you go, Pramod, leave us with some 2-3 ideas top of mind from the broader mid-cap universe.
I would name, say, Supreme Industries, Bajaj Electricals, and Finolex Cables. All three of them are under our coverage, and we have a buy recommendation. These are high-quality companies with high-quality brand and distribution in place, and then clearly beneficiaries of any uptick in capex and spending in electricals and sort of proxy plays on infrastructure.
Very quickly, actually, Supreme, from 2009 at a 30 rupee price point to 470, that's what, a 15x return. You still like it?
Yeah, even at 470, it's trading at about 16 times earnings. That goes to show how they've driven earnings in the last 5 years from 2009. It's not just price appreciation. Earnings have grown very strongly, and they've reached an inflection point in terms of breaking into the big league, putting manufacturing capacities across the country, cutting freight costs, expanding margins, a very extreme focus on return on capital employed, churning their assets and capital very efficiently. At 16 times, I would think there's enough value in this company going forward as well.